Have you ever felt like the stock market is a rigged game? Like there is some secret exclusive club of wealthy investors who know exactly what they are doing, while the rest of us are just blindly throwing darts in the dark hoping to hit the bullseye? For a long time, I felt exactly the same way. When I first started my investing journey, I was completely obsessed. I read every single book I could get my hands on. I followed every financial guru on the internet, and I analyzed company earnings reports until my eyes literally hurt. I genuinely thought the secret to wealth was working harder than everyone else and finding the next big thing before the rest of the world caught on. Welcome back to Grow with Tony. I'm so glad you're here with me today. Just a quick reminder before we dive in. This episode is for educational purposes only and is not personalized financial advice. So, back to that feeling of the market being rigged. A few years ago, after exhausting myself trying to outsmart Wall Street, I stumbled upon a single piece of data. It wasn't a hot stock tip from an insider. It wasn't a complex whiteboard-level mathematical formula. It was just one simple chart, and honestly, staring at that chart felt like a physical punch to the gut. It completely shattered everything I thought I knew about making money in the markets. But more importantly, it changed the way I invest forever, and it gave me my life back. Today, I am going to share exactly what that chart revealed, why it exposes the ultimate psychological trap that almost all of us fall into, and how you can flip the script to finally build real, effortless, and lasting wealth. Let me paint a picture for you. Imagine a study that tracked the average annual returns of different types of investments over a massive 20-year period. Specifically, we're looking at the years between 2002 and 2021. Now, over those 2 decades, the market went through a lot. We had the recovery from the dot-com crash, we had the devastating 2008 global financial crisis, and we had the massive crash and rapid recovery of the 2020 pandemic. Despite all of that chaos, the S&P 500, which is basically an index of the top 500 largest companies in the United States, averaged a very healthy 9.5% return per year. Think about that. Even with the global financial meltdown, the market delivered nearly double-digit returns on average. Even if you played it incredibly safe, with a conservative, boring portfolio made up of 60% stocks and 40% bonds, you still walked away with a 7.4% average annual return. But then, I looked at the bar on this chart for the average retail investor. Retail investor. That is the industry term for you and me. That is the everyday person logging into their brokerage account on their phone after a long day at work. Take a wild guess at what the average everyday investor made during those exact same 20 years. 3.6%. Let that sink in for a second. The overall market was practically handing out a 9.5% return every single year, and the average person only managed to capture 3.6%. That return is so low that it barely keeps up with the cost of inflation. In real purchasing power, the average investor essentially went nowhere for 2 decades. Let's put some actual dollars behind these percentages so you can truly feel how devastating this gap is. Imagine you had $10,000 to invest at the start of that 20-year period. If you simply bought an S&P 500 index fund, matched the market, sat back and did absolutely nothing for 20 years, your money would have grown to over $61,000. You didn't research a single company. You just let American business do the work for you. But what about the average retail investor working hard to manage their money? At that 3.6% rate, that same $10,000 only grew to about $20,000. That is a $40,000 gap. It is a staggering difference. It is important to note that these people didn't lose all their money, which is what most people are afraid of. But they did something almost as bad. They left a life-changing fortune completely on the table. As soon as I saw this massive discrepancy, I had to know why. Why are we so incredibly bad at this? Why do smart, hardworking people consistently underperform the very markets they are investing their hard-earned money into? The answer doesn't have anything to do with intellect, and it doesn't have anything to do with math. It comes down entirely to human psychology. Our brains are biologically wired to survive in the wild, not to trade stocks. There are 3 massive mental traps that actively destroy our wealth, and the first one is practically hardwired into our DNA. It is the fear of missing out. FOMO. Think about the late 90s with the dot-com bubble, or the explosive crypto crazes over the last few years, or whatever hot artificial intelligence tech stock is dominating the headlines right now. When we see a market absolutely exploding upwards, something triggers in our brains. We start hearing stories at the office or seeing posts on social media about a neighbor, a friend, or some random teenager on the internet who just bought a sports car because they got in early on the latest trend. When you hear that, a profound sense of panic sets in. It actually feels like a physical ache. We tell ourselves, I am missing the boat. I need to get in right now before it is too late, or I'm going to be poor while everyone else gets rich. So, what do? We abandon our long-term plans. We scrape together whatever cash we can find and we throw our money in at the absolute peak of the hype cycle. We buy when everyone is euphoric, right before the bubble bursts. We are not investing based on rational logic or the fundamental value of a company. We are investing based on the agonizing, desperate fear of being left behind. And usually, the moment you finally cave and buy in out of FOMO, that is exactly when the smart money is selling. Which leads us directly into the second and arguably most destructive wealth-killing trap, trying to time the market. This is the ultimate portfolio killer. Let's follow the timeline of the FOMO investor. What happens a few months or a year after you buy at the absolute peak out of pure excitement? Eventually, the market dips, or worse, it crashes completely, like it did in 2008 or early 2020. Suddenly, the euphoria is gone. The news cycle flips. The headlines are screaming in bold red letters that the economy is collapsing, businesses are going bankrupt, and the world as we know it is ending. Human beings suffer from something behavioral economists call loss aversion. The psychological pain of losing $100 is roughly twice as intense as the joy of making $100. So when your portfolio is down 30 or 40%, the pain is unbearable. You log into your app, see the red numbers, and your fight or flight instinct kicks in. So what does the average investor do? They panic. They hit the sell button to stop the bleeding. They convince themselves that they will sell now, hold their money in cash, and just wait for things to calm down before getting back in. Do you see the massive tragedy here? We are letting our raw, unfiltered emotions force us to do the exact opposite of what makes money. We buy out of greed when prices are at their absolute highest, and we sell out of sheer terror when prices are at their absolute lowest. And here is the worst part about market timing. Once you sell at the bottom, you are paralyzed. You sit in cash, waiting for the sky to clear, and for a perfect, safe moment to get back into the market. But the market doesn't send out an invitation card when it is about to recover. The biggest days of recovery almost always happen in the middle of the worst news cycles. If you wait until the economy feels completely safe and the news is positive again, you have already missed the massive rebound. You locked in your losses, and you missed the growth. It is a brutal cycle. Now, if FOMO and panic selling weren't enough to drain our accounts, we have the third major trap: the endless pursuit of the shiny new toy. As humans, we are obsessed with finding patterns, and we love chasing last year's winner. In the financial world, there is a fascinating visual tool called the asset heat map. It tracks which types of investments, like large US stocks, emerging markets, real estate, bonds, or commodities, perform the best each calendar year. If you look at this map over a decade, it looks like colorful chaos. One year, US tech stocks are the absolute champions, returning incredible numbers. The average investor sees this and thinks, tech is the future. I'm putting everything in tech. But the next year, tech crashes, and suddenly boring commodities like oil or gold take the crown. The year after that, international emerging markets are the big winners. The average retail investor is always looking in the rearview mirror. They look at what won last year, and they move all their money there expecting it to keep going up. But markets are cyclical. By the time you move your money into last year's winner, you are almost always arriving one step too late. The run is over, and the market is rotating into something else. It is a stressful, exhausting, and incredibly frustrating game of musical chairs. And let me let you in on a little secret. It is a game you are mathematically guaranteed to lose over the long run. Even the highly paid professionals in tailored suits on Wall Street fail to predict these sector rotations consistently over a 10 or 20-year period. If the pros with supercomputers and teams of analysts can't guess what the hottest sector will be next year, why do we think we can do it on our lunch break? So, this all sounds pretty bleak, right? If our own brains are wired to make us fail, how do we break the cycle? How do we escape that miserable 3.6% return and actually capture the incredible wealth that the global market naturally wants to give us? The solution is surprisingly simple, but I will warn you right now, simple does not mean easy. It requires intense discipline and a complete shift in how you view your money. I have boiled it down to 3 core rules that completely changed my financial life. Here are the 3 rules I live by today. Rule number 1, stop looking for the needle in the haystack and just buy the entire haystack. This is a concept championed by the legendary investor John Bogle. If you want to achieve the returns of the broader market, you need to literally own the market. Stop trying to guess which specific artificial intelligence company is going to win the tech race, or which electric vehicle brand is going to dominate the next decade. The odds of you picking the single winner are incredibly low. Instead, just open a brokerage account and buy a low-cost, broad-market index fund, or an ETF, like one that tracks the S&P 500 or the total world stock market. When you buy an index fund, you are buying a tiny slice of hundreds or thousands of the greatest companies on Earth, all at once. The beauty of an index fund is that it is self-cleansing. If a company does terribly and goes bankrupt, it falls out of the index and is replaced by a newer, stronger growing company. You don't have to monitor it. You don't have to read financial statements. You just capture the overall upward trajectory of human progress and innovation. It is cheap, it takes zero effort, and history shows it instantly makes you a more successful investor than the vast majority of active traders out there. Rule number 2. You must embrace the roller coaster. You have to fundamentally accept that volatility, the wild ups and downs of stock prices, is simply the price of admission for building wealth. You cannot get the reward without taking the ride. The stock market is not a high-yield savings account. The value of your portfolio will go down at some point. That is a guarantee. In fact, historically speaking, you should expect the market to drop by at least 10% almost every single calendar year. You should expect a fairly scary 20% drop roughly every 4 to 5 years. And you should mentally prepare yourself for a massive, terrifying 30 to 40% crash about once a decade. I need you to understand this. These crashes are not a glitch in the matrix. They are not a sign that capitalism is broken. This is exactly how the system is supposed to work. When you study market history and you expect these drops to happen, you completely strip away their psychological power to scare you. When the market bleeds and the media tells you to panic, you do not sell. You hold your ground. You remind yourself that you are playing a 20 or 30-year game, and today's news simply does not matter. And finally, rule number 3, become a robot. I mean this quite literally. You need to remove human emotion from your investing process entirely. Invest regularly, ruthlessly, and automatically. This is a concept known as dollar cost averaging. I do the exact same thing every single month, like clockwork. The day I get paid, a set percentage of my income is automatically transferred from my checking account directly into my investment accounts, and it automatically buys my chosen index funds. I don't touch it. I don't think about it. I genuinely do not care if the financial news that morning is wildly optimistic. I don't care if the news is doom and gloom. I don't care if the market is sitting at an all-time record high, and I certainly don't care if it is in the gutter during a recession. I just buy. When the market is high, my monthly contribution buys fewer shares. But when the market crashes, that exact same monthly contribution acts like a vacuum, scooping up a huge number of shares at a massive discount. Listen to me. True, successful investing shouldn't be a thrilling adrenaline rush. It shouldn't feel like you are at a casino in Las Vegas. Good investing should actually be incredibly boring. It should be like watching paint dry or watching grass grow. Get your money into the broad market, set your contributions on absolute autopilot, and then close the app and go live your life. Go spend time with your family, focus on your career, work on your hobbies. Let the brutal, beautiful mathematics of compound interest do the heavy lifting for you in the background. Before we wrap up this episode, let's do a quick recap of what we actually learned today, because I want this to stick with you. You learned that the average retail investor loses massive amounts of potential wealth, not because the stock market is a scam, and not because they aren't smart enough, but entirely because of their own behavioral psychology. You learned that making financial decisions based on the fear of missing out, trying to perfectly time the tops and bottoms of the market, and constantly chasing the latest trending sector is a guaranteed recipe for financial frustration and underperformance. And most importantly, you learned the true, boring, but highly effective blueprint for financial success. Stop picking individual stocks and instead buy broad market index funds to own the entire global economy. Accept that scary, double-digit market drops are completely normal and part of the process. And finally, automate your investments so you buy consistently every single month without ever letting your emotions get a vote in the decision. Real wealth isn't built by being the smartest person in the room, and it isn't built by predicting the future. It is built by being the most disciplined and the most patient. Thank you so much for tuning in and spending your time with me today. If this episode shifted your perspective or gave you a light bulb moment, please do me a huge favor, hit that like button right now. Make sure you subscribe to the channel and ring that notification bell so you never miss an episode. It really helps the channel grow and reach more people who need to hear this message. Also, I want to hear from you. Drop a comment down below and let me know. What investing or mindset topic do you want me to break down in the next video? Your suggestions shape this channel, so let me know what you want to learn. Until next time, stay patient, stay consistent, and keep growing.